but what has to happen to get it there. And as we wait on Alphabet earnings, the focus, no doubt, there will be whether massive spending on the build-out of artificial intelligence will continue. Here's what's expected on that particular front. For the quarter, analysts believe Alphabet shelled out $45 billion to build out the infrastructure to run its AI platforms and ambitions. Guys, that's a 101% jump year over year. Look at what Wall Street thinks CapEx for all of 2026 will touch over at Alphabet. $187 billion. Now, back in February, CEO Sundar Pichai guided to a range of $175 to $185 billion, but then months later, he hoisted that to between $180 and $190 billion. Key question, will he raise or maybe pull back from that, and how should investors position ahead of it? Let's get right to the floor show. Joining me now live from the SIBO floor, Prosper Trading Academy CEO Scott Bauer, an experienced options trader, I might add. Scott, this is not just an earnings report. It is a report card on the AI build-out, if you will. What can you tell from the options activity right now about whether Google will hit the gas or tap the brakes on CapEx spending?
Yeah, this one's likely to kind of set the landscape out there. And right now, options flow is pretty mixed. A little bit of an edge on the call side here, but I would say it's very cautious, Liz. And, you know, you were just talking about the CapEx spending, and it's really a double-edged sword, because even though they just raised it to, 180-ish or so, let's say they come out and they raise it again, okay? The market's not going to like that. On the flip side to that, if they were to lower it, which I doubt that's going to happen, the market may say, uh-oh, what's going on here? So the market's pricing in about a 6% move or so. Again, the option flow is slightly tilted on the call side here, but, that 6% move, that's pretty high. So we could see a pretty wide range here. And again, people have to be really careful, Liz, because those numbers come out right after the bell and we'll see a move, but it's not really until we get the conference later on that we'll see the real move.
Yeah, but would you say, Scott, that the options traders believe that this is going to be sort of a very questionable psychological response to numbers? Because if they raise the spend for CapEx a full year, 2026, doesn't that mean that people might get even more nervous that there's too much spending? Or if they pull it back, there might be a complete freakout. So you almost can't win either way.
Yep. No, you're right. And that's, I really think they've got to keep it right there in that 180 to 185 number and just say we're comfortable with that. We like where we're going. Google, Alphabet, they have some really good metrics. They really do. They do have to start monetizing all of this CapEx, just like all the other big companies do. That's what the big concern on the street is.
Well, the hyperscalers right now are all moving lower, but Google sort of year-to-date is the best thing going. It's up nearly 11% year-to-date. Amazon's in the green by around 5%. But let's see, Meta, Microsoft, those two are in the red year-to-date. Let's get to the broader market. And the fact that you've got the S&P and the Dow within about 2% of record highs. So time to remain bullish and stay with this momentum trade?
I think you really can. There's a lot of dispersion out there. When I say there's dispersion, I'm talking about option premium volatility. So in the indices like the S&P and in the Dow and even in the NASDAQ, overall volatility, Liz, is very inexpensive. So it's very easy to buy some hedge, to buy some downside protection if you wanted to keep your portfolio long in the marketplace. That dispersion comes in because if we go towards looking at some individual companies, whether it's Alphabet, Microsoft, anywhere across the tech space, those things are as expensive as they have ever been. So individual stock vol, really expensive. Index vol, really, really cheap. So for me, I like staying in, positions longer term. I do think the market's going to move higher longer term, but at the same time, buying really inexpensive insurance to the downside.
Okay, but specifically index. You're talking about the VIX on index, that kind of downside protection.
Absolutely. Whether you buy upside VIX calls, whether you're buying downside S&P puts, downside triple Q or NASDAQ puts, relative, it's very, very inexpensive. So for me, I'm going to have that comfort level where I can stay allocated in the marketplace, but I can have protection to the downside.
I mean, the VIX right now, we're looking at below 17. That means markets are rather complacent at the moment, although I think that belies some little bit of flurry and drama underneath the surface. Scott, good to see you. Thank you very much.